Have you heard about the Pi network? It's a digital currency project aiming to make crypto accessible to everyone, right from your smartphone. Unlike Bitcoin, which needs powerful computers, Pi lets anyone mine coins with just a tap. Millions of users, called pioneers, have joined, all wondering, what will one Pi coin be worth? The answer hinges on the launch of Pi's open mainnet, when coins can finally be traded for real money. Recently, a jaw-dropping number appeared: $314,159 per Pi IOU on the MEXC exchange. An IOU here is just a promise to deliver real Pi coins later, but the price got everyone's attention. Is this number just hype, or is there a method behind it? Turns out, it's based on a technical system designed to set a stable value from day one. We're about to break down the science and math behind this price. How can a coin have a set price before it's even fully available? By the end, you'll see why $314,159 isn't just a random figure. It's a bold experiment in digital finance. Let's dive in. $314,159 isn't just a random number. It's a direct nod to the mathematical constant pi, 3.14159. The Pi network has always leaned into this symbolism, linking their currency to the idea of infinity and endless potential. But is the price just a clever reference, or is there more to it? Many skeptics think it's a marketing stunt, especially since Pi isn't yet freely traded. However, MEXC didn't pick this number out of thin air. They built a technical framework to support it. The price is anchored by a mathematical formula, not just speculation. This formula is designed to keep the price stable and predictable, avoiding the wild swings typical of new cryptocurrencies. The goal: inspire confidence and show there's real thought behind the valuation. To understand if this price is hype or substance, we need to look at the formula itself. Let's see what makes it tick. At the core of Pi's price on MEXC is a mathematical equation, V, I1, 314,159, plus EN010. Think of it as a recipe for stability. VI is the new price, calculated every time the system updates. The formula runs constantly, making the price dynamic but controlled. The first part, 314,159, is the anchor, the base value. The second part, 0.9 times the difference from the last price, smooths out changes. The third part, E010, is a tiny adjustment based on real-world data. This isn't just a string of numbers, it's a self-correcting system. The formula uses its own history to predict the next value, keeping things steady. It's a common technique in finance to avoid chaos. Let's break down each part to see how they work together. First up, the anchor. The anchor, 314,159, is the foundation of the pricing model. It acts like gravity, always pulling the price back to this central value. This isn't just psychological, it's programmed into the formula. By setting a high, firm anchor, MEXC signals that Pi is meant to be a serious asset. This discourages wild speculation and encourages long-term holding. Unlike most coins that start low and swing wildly, Pi's model aims for immediate stability. The anchor keeps fluctuations in check, so even if the price moves, it gravitates back to $314,159. It's a bold way to skip the chaos of price discovery. The anchor is both a technical and community statement. Pi's value is built on collective belief. Everything else in the formula revolves around this number. The next piece is the memory factor, 0.9 times the difference between the last price and the anchor. This connects the new price to the previous one, ensuring smooth transitions. If the last price was above the anchor, this term gently pulls it down. If below, it nudges it up. The 0.9 is a smoothing factor. It dampens overreactions and keeps the price from swinging wildly. Think of it like a shock absorber, softening every bump. The system only adjusts 90% of the way back, never overcorrecting. This gradual correction is what keeps the price chart stable and predictable. It's a thermostat for value, always checking and adjusting toward the target. The result? A price that remembers where it's been, but never strays too far from home. This is how the formula maintains order in a volatile market. Now, let's look at the final ingredient, ES010. That's where real-world data comes in. M010 is the wild card, a tiny calculated adjustment based on real-world data. In math, epsilon usually means a small error or random variable. Here, it's not just noise, it's a bridge to reality. MEXC calculates ERO10 using live data, social sentiment, user activity, and actual on-chain transactions. If someone trades Pi for another currency, that info tweaks the price, just a little. The 010 means the adjustment is tiny, so no single event can crash the price. This keeps the model stable but responsive, letting it drift slowly if real-world trends persist. Epsilon ensures the price isn't isolated from reality, but it won't let hype or panic take over. It's a gentle nudge, not a shove. This balance is what makes the system robust. Now let's see where this real-world data comes from. The formula's real-world input comes from 4 data pillars. First, community consensus, tracking social media, forums, and polls to gauge belief in the price. Second, ecosystem development, measuring network growth, active users, and new Pi apps. Third, on-chain transactions, watching for real trades, even if Pi isn't fully open yet. Fourth, data from other exchanges, comparing Pi prices elsewhere to avoid isolation. These layers work together to give a full picture of Pi's value. Community sentiment reinforces the anchor, while real trades provide hard evidence. Ecosystem growth justifies a high valuation, and cross-exchange data keeps things honest. All this data feeds into the formula, making the price more reliable. It's not just theory, it's grounded in what's actually happening. This multi-layered approach is key to the model's strength. But how does all this data get combined? Enter the Oracle aggregator, the system that filters and combines all 4 data layers. In crypto, an oracle brings real-world info onto the blockchain. MEXC's aggregator checks, verifies, and weighs each data source. It filters out manipulation, like bot-driven social spikes or fake trades. On-chain transactions get more weight than tweets, ensuring real value drives the price. The aggregator creates a single, trustworthy input for the formula's E010 term. This process shields the price from hype and herd mentality. The result? A stable, defensible price based on verified data, not just momentum. It's a technical safeguard in a noisy market. Why all this complexity? To create stability in a famously volatile crypto world. Most coins swing wildly, making them risky for everyday use. Pi's model aims for predictability from the start, reducing risk for holders and traders. Stable value makes Pi more attractive for real-world transactions and business adoption. This approach could set a new standard for launching digital assets, anchored by community belief and technical rigor, not chaos. If successful, it could inspire other projects to rethink how they launch and value tokens. The $314.159 price isn't a gimmick, it's the product of a deliberate, scientific system. Anchored formulas, verified data, and smart aggregation resist hype and build trust. For Pi's millions of pioneers, this is a reason for optimism. It's a serious effort to make digital currency stable, valuable, and trustworthy. And that's a breakthrough worth watching.